the market has been doing well. Under Trump's administration, he wants to see the market do well. That is how he measures his success, and that's how he's trying to say, "Hey, everybody, look at your 401k. They're doing great. This is the kind of presidency I have." So that's going to be his message. As far as what the other kind of metrics and mechanisms are going to be out there, like the Fed growing their balance sheet to help us out, there's going to be some debate about that. Some of the interesting things we've seen is that despite the market going up like this, we're also seeing bonds go up. So TLT, we're seeing gold, precious metals start to go up. And we don't usually see those go up when an equity market is strong. And we're trying to figure out where these disconnects are coming from and why.
Thanks for watching this RTD interview. Don't forget to pick up your RTD Scary George round, only available at stbullion.com. Now enjoy this interview. Welcome to this RTD interview. Today I'm excited to have first-time guest TG Watkins joining us here to share his thoughts on the financial markets and a variety of other subject matter. He's a director of stock trading at Simpler Trading, and today he's joining us to share his thoughts. So TG, welcome to RTD.
Well, thank you very much. How are you doing today?
I'm doing excellent. I appreciate you taking time to sit down with us and share your thoughts on the equities markets. And so for my viewers, we're predominantly a precious metals type of channel. And so the equities markets is something I'm looking to find out more about in depth from your standpoint and get your thoughts as to where it's at, where it's heading. But before we dive into that, can you give us a little bit of information as to who TG is and how you've arrived at this point in your career?
Yeah, well, the short synopsis is that I graduated with manufacturing engineering. So the way my brain kind of works is very engineering-like. And then I sidestepped. I worked with New York Life as a financial advisor for a few years. And then I kind of took that and I rolled it over into stock trading because my dad managed his own money when I was growing up. So I always kind of would sit on his lap and look at charts. It was something that kind of came back to me, and it was a passion I wanted to do because I like the idea of being self-employed. And so I was stock trading for several years. It took me a long time to kind of figure it out. Finally got some stuff figured out and created my own indicator, turned that into a business, ran that for a few years, and then I wanted to get even bigger and better. And then that's where I ran into John Carter, who owns and started Simpler Trading. And now I've been here for about a year, and I'm loving it. I get to go and meet a lot of people. I have a bigger channel. I got more people I can go out there and help them grow their money and figure out ways to trade and just do what they want to do as far as their financial future.
Sounds good. So I appreciate you for sharing that with us. And so I'm curious to find out. And so I guess, we can go right into the equities markets. And so I'm definitely looking forward to finding out more information according to your perspective and background. And so right now, Dow Jones, it seems to be the leading indicator. And our president loves to use that particular measurement as a guide and gauge for the health of our economy. But on the more of the contrarian viewpoint, I have questions and concerns about that. So I want to find out your thoughts. But at this current moment, roughly 29,000, not sure what it is today, but 29,000 Dow. And so, is there anything that concerns you about where the equity market is now and where it could possibly go? Any chance of a correction? How severe? Give us some things that probably concerns you.
Yeah, well, right now we are in a bit of a correction. It started Thursday, Friday. And really when it comes to the markets, when we see things really start to pick up a lot and very quickly, they become stretched and unsupported. And that's kind of what we've been seeing in the market actually for the last couple months. We've all been sitting here like, all right, when is this thing going to pull back? It's not often that price just keeps going up and up and up and up. And we're finally starting to see some of that as of late last week. And then today we got a pretty big gap down over the weekend. Part of what we're seeing is that's really started this move is that the Fed is starting to expand their balance sheet, which basically means QE, so quantitative easing. They tell us not to call it that. They're not calling it that, but that's basically what it is. They're starting to pump some money into the markets, and we are a little concerned about that. What's going on with it? What does that mean? But otherwise, the rest of the market seems to be doing very well. It's just that right now it's a little overheated, so we appreciate these pullbacks. We do look for price to come back down. We want them to be reset, and that way it kind of sets the next motion off. And so far, everything's looking okay for now.
All right, sounds good. So I'm curious to find out your thoughts based upon your analysis. And so assuming that you do a lot of technical analysis and things of that nature. And so I have no education in that particular subject matter and how to do it. So I'm curious to find out some of your measurements and guiding and some of your processes for discovering true undervalued share stocks that you can get into. And because a lot of the concerns that I have, a lot of my guests have, is the fact that the PE ratios is a little bit abnormal, give or take prior historical aspects and all the technical things. And so I personally don't know what's good or what's from bad. So how would you grade and recognize something worth looking into further and possibly investing in it?
We're a little bit shorter term than something like that with the PE ratio. That's more like fundamentals. We're more technical, so we really do kind of just look at the charts, and we do look at other metrics that are a little bit quicker to understand. We look at the put call ratio for the overall market, which has been extremely low for several weeks, and that was one of the things that we've been looking at, saying, well, how long can how long can the put call ratio stay this low? And today we're starting to see it, jump right back up. So it's starting to get back into a more normal situation. Another thing that we look at is the short interest. So we love short interest and what that means is how much of the stock that's out, how much of the float are people holding short, meaning they want it to go down. And what happens is when those shorts are wrong and the price starts to go up and they need to get out, they can't just get out. They actually have to buy the stock back in order to get out. So it's almost like it's double buying, and that can really, it's what we call a short squeeze. It can really make the market or this particular stock just really take off. And so that's one of the things that we look at quite a bit. Looking at some of the other stocks, trying to figure out what that is, we've been seeing a lot of some newer names, some older names, Shake Shack, Beyond Meat, CGC, Cron, some of the weed stocks out there, SDC, which is Smile Direct, Pinterest. A lot of these stocks have been beat up for a very long time. They go into the end of the year, they finish their tax loss selling, and there's nowhere left to sell, and all this high short interest has to go someplace. And so when the match lights, the shorts have to get out, and it really spikes these things up. And we saw a major rally the last couple of weeks in these. We're letting them kind of fade back down, and we're looking to get back in a couple of weeks.
Interesting. So appreciate you for sharing that. And so earlier on, you referenced things that concern you and the repo market, QE, all that stuff that's happening right now. I would imagine that, and a lot of people would say that the amount of liquidity that's been provided into the markets to whatever institutions that needs them is also correlated with the increase of the Dow, especially, and I'm sure everything else. And there's graphs out there that shows, as QE went up or not QE went up, so did the equities. And it's a correlation of where people think that it's direct injection and the increase in value of the equities markets. Would you say that's kind of similar and connected? And is that going, if this not QE continues as it is now, do you see also equities also continuing a trend along with it, therefore creating a higher share price of the Dow?
Yeah, generally we're going to be seeing that. We're going to be seeing QE apparently keep growing. The Fed's balance sheet, the market has been doing well. Under Trump's administration, he wants to see the market do well. That is how he measures his success, and that's how he's trying to say, hey, everybody, look at your 401k. They're doing great. This is the kind of presidency I have. So that's going to be his message. As far as what other kind of metrics and mechanisms are going to be out there, like the Fed growing their balance sheet to help us out, there's going to be some debate about that. Some of the interesting things we've seen is that despite the market going up like this, we're also seeing bonds go up. So TLT, we're seeing gold, precious metals start to go up. And we don't usually see those go up when an equity market is strong, and we're trying to figure out where these disconnects are coming from and why. The bond situation, I think, is because the interest rates have been going down. The Fed has been lowering interest rates. So, the price of the bond goes up. We're looking at that. As far as precious metals, we're thinking that people are trying to hedge against a low interest rate environment, basically, because bonds are low. Like, where else are people going to put their safe money or their hedging money? Well, probably put it into precious metal. We are seeing a little bit of tension, not so much with China anymore, but maybe a little bit of the Middle East. So that tends to raise gold. These are some of the things that we're trying to kind of understand in the greater macro scenario that's going on with the overall market.
Interesting. Now, assuming you're not just limited to the U.S. and the economy and all the events happening here, in your personal opinion, from a macro standpoint, all the activity happening outside our country. So right now, as of today, the Wuhan situation looks to be something that can impact equities globally. And so, are there any concerns that you, as someone who probably does work short term as opposed to investing long term in certain portions of the equities market, is there things that concern you based upon outside events that could cause some issues within our country or outside equity markets or other nations?
So far, we haven't been seeing too much. This outbreak that has been happening in China, we're trying to put this into context. I mean, I forget the stats, but people are saying, how many thousand people die from the flu every year? Or how many people die in car accidents every year? compared to the number of people who are dying in the flu over there with this disease in China. So we're trying to put it in perspective. We're trying to, really see, is this more of a news situation? The market kind of coincides. We've been looking for a pullback with the market with this. It just has been coinciding with this epidemic, outbreak situation. So, there's a lot of times that things kind of line up and we try and figure out, is it real or is it just an excuse or is it just the news that's trying to, are we just looking for an answer? For the most part, we're not going to be too worried about it so far. If we start seeing something that is more impactful on our shores, like if it starts to come over here, I've heard rumors I need to look a little bit more. I've heard like 1 to maybe 3 people in America. That doesn't seem like it's too big of a deal yet, but so far it seems like they're working on it. They're going to try and keep it contained. I think, years ago when we had the Ebola thing, America was on that pretty strongly and made sure that it didn't go anywhere and that we contained it. I imagine we're going to be doing the same thing here with this thing.
All right, good point there. Now, another possible indicator that I've noticed in prior months and years is how it looks like the current administration, especially President Trump's activity on Twitter, seems to cause a little bit of spikes. So whenever our president tweets, in a sense, there's usually some activity. And I from my standpoint, I'm curious to find out how much of a impact on the president's tweets, whether it's a strong economy, whether he's mad at the Fed or Reserve, or he's just being himself. How much of that does that play on the day-to-day or your long-term concern on certain portions of sectors in the equities market or not at all?
Yeah. I mean, honestly, you see me laughing and smiling about this. Back when Trump was starting his presidency, it was a big thing. He was going after some companies. He really was talking about them either in a positive or negative way. And then he transitioned into the Fed situation that he was kind of ripping on about them. A lot of that is kind of gone by the wayside. I mean, there's a lot of other stuff that's keeping him busy, a lot of other news that's keeping him busy, a lot of stuff that's going on. So we're not seeing too much of that anymore that's directly affecting the market. I mean, it definitely was a thing when the Fed was trying to figure out, okay, what are we doing about interest rates? Are we going to raise them, lower them, whatever? And then back when he was kind of bashing on some companies or trying to get companies in here, there were people who actually were trying to make trading bots to read his tweets and then go, look at that stock and either buy or sell it. It's kind of calmed down amazingly. So, and the other thing I've been noticing is he's just been retweeting a lot of stuff. So it's actually kind of hard to pick out when he kind of has his own particular or own personal tweet that might be going someplace. But as I said, I think most of the tweets right now aren't really about any specific thing related to the market or a company. And so we haven't been seeing any direct correlations yet. So far, he's just been a big cheerleader for the market and for America. And so it's been going up for quite some time.
Yeah, you mentioned bot. And so
Yeah.
I realized looking at President Trump's Twitter account, there's a lot of like 3 a.m. tweets and 4 a.m.
Yeah.
So just as a opinion piece, what's the chance that our president has a bot and that has some type of automated every now and then he has something set up to where it just throws out certain tweets on certain subject matter?
Well,
What's the chance?
I think that he's got staff. I think that's what I'd be looking at is he has staff and, maybe they are up at all hours of the night. I mean, some of the Senate stuff that's going on, they've been going till 2 o'clock in the morning. So it's possible. And then I just also wonder about the direct correlation of when somebody sends out a tweet and when we might actually receive it. I know that sometimes just because the sheer number of tweets and, computer systems in between, you may not actually get a tweet right away from when it was sent out.
Right, good point there. I appreciate you for clarifying that for me because I was wondering about the times of sometime. I'm thinking like, who's really that active? But it's the president's account, so definitely have staff.
Yeah.
And so I'm curious to get your thoughts on a couple other things that I think will be long-term indicators of the health of our economy. And so this phase 1 of the trade deal.
Yeah, it seemed pretty great so far.
So far, so good. Now, also along with that, there was the concerns that same week or a week before, we had a little situation where there was a scare of the possibility of war based upon the Iran, Iraq, that whole little situation there. War typically, how does war, does that play in like a normal possible, activity that can cause a dip or cause an increase, or what's the typical, activity for when there's mention of war? Thanks for watching this interview. If you're enjoying content like this, feel free to become a part of the RTD community by becoming a member via Patreon. All it takes is a monthly contribution of about $5 a month for more great content such as this. Just scroll down beneath this video here and click the Patreon link, and then hit this tab right here to become a member of the team. Looking forward to bringing you more great content. Now, let's get back to this interview. Thanks.
Yeah, it can be. It can dip the market. It can really pop other situations. Like when that whole Iran thing did happen and they were sending out some missiles. If you look at the futures overnight, it really took a pretty big dip, but then it came right back. And by the time the market opened, it was actually up a little bit. So all this kind of stuff happened overnight because it was overnight. And it just kind of depends. If you look at defensive stocks, well, they're going to take off. You look at gold, which is defensive, they're going to take off. So we're going to be looking at some of that stuff if there is going to be continued troubles in the Middle East. As far as the overall market, yeah, they probably don't like that. We don't really want to be seeing some turmoil. We don't want chaos. We don't want anything globally that's going to affect tensions. But so far, it seems as though, a little bit of a spat. Kind of had to do some stuff, get some stuff straightened out, and it seems to have all calmed down. And as far as the phase one deal, I think that's the bigger picture that's overriding stuff. And so far it happened. I mean, he was telegraphing that the phase one deal was going to be completed, and we didn't really know what that was or what was involved, and who knew that there was a phase one versus a phase two. But it's here. It got signed. I listened to the speech and everything he said. There was a lot of pomp and circumstance, but they said some really good, strong stuff about the potential future in phase two. So I know it's political, but we got to take what we can. And it sounds like they're really working on trying to make things go forward with our relationship with China, especially economically.
That sounds good. I appreciate you sharing that. Now, I'm curious to get your thoughts on just looking at the current health of our economy, whether it's artificial or real, QE driven or not. We're 10 years due or 10 years past the last economic recessionary type of the great financial crisis, as it's called. And so once again, typically the business cycle is every 6-7 years, there's a correction. Mm-hmm. And so I want to get your thoughts on, based upon the graphs, or have you noticed any unusual activity when you're watching the graphs or whatnot, or just doing what you do that can kind of pinpoint and see a slowdown here or increase there? Or is that something that you can actually grab a hold of from the graphs and things of that nature that you look at?
Yeah, usually some metrics we look at transports, the transport ETFs, the transport market. We try and look at, say, the yield curve. That was a big hot topic for a while, the inversion of the yield curve. It's become uninverted at this point. There are some things we try to look at. So far, nothing has really stuck. Might have gone someplace, but it didn't really stick. The transport market did kind of slow down for a little bit, but now it's at least kind of back up there. The yield curve, it did invert. Now it's kind of back. We're really not sure. We're kind of in uncharted territory. You're talking about the business cycle. Absolutely. We're talking about how long does a bull market last. We've never had one last this long, but we've also had some fairly good corrections within it. We've never had interest rates this low for this long. We've also never had the QE, the Fed actually buying assets for this long for a second round. So we really are in uncharted territory, and it's kind of hard to figure out what's going on. I also follow a lot of economic stuff, and we talk about booming economy. Okay, well, what about with these metrics? And it's really, really tough to actually figure out what's real or what's true and how that compares to back in the day, because sometimes they change what the metrics are. They change the thing we measure them by, the ruler, so to speak.
Right. Now, as a result of the environment we're in now, 10 years plus removed, the longest expansion, I believe, in our equities history, or just history in general. Yeah. I imagine that, this is not me being a doom and gloom guy, but just being realistic, you have an artificially extended time frame. I imagine when things happen to correct, assuming that you believe that there has to be a correction, how severe could that correction be, given the fact that if everything was artificially induced, then if there was a correction, that means that it might be an extended time frame of things having to correct, or is that subject to monetary policy, or what? What would a true game-changing correction possibly look like, if at all you believe that's possible?
Well, another couple of factors that you might want to include in there are algorithms, black boxes, the fact that 70% of all trading happens with computers. And what this has been doing is it's kind of been having to make us as humans kind of relearn the stock market a bit, and just we have to understand that the algorithms are trading most of the market. And so when things move, especially to the downside, they move very quickly and they move a little bit deeper than we would normally do if just humans were trading this stuff. So that is something that we do need to be aware of. We just kind of need to factor that into our trading and say, okay, just get out when we need to. For now, if you're talking about the overall, either a recession or a bear market or a change of trend, you really should look at the moving averages on higher time frame charts, namely like the monthly or the weekly time frame, or look at the 200 SMA on the daily time frame for the overall market, like the Dow and the SPY and anything like that, because that'll tell you what the overall trend is. As long as price is over those, and as long as those moving averages are still up, then we're still in an up to sideways market. So far, we haven't seen anything yet that's going to tell us that this has changed. Last thing we saw was in December. It was a 20% correction. It was very stiff and for 3 months. But look what we did afterward. It was a very, very healthy correction that we needed. And that's kind of what we're looking at and saying, well, what's the next big one that we need to look out for? But we don't see it yet.
All right, sounds good. Now, I'm curious to get your thoughts as to the technical analysis side of things that, is more short term. And then you have the long-term investing, as you mentioned earlier about the 401ks, retirement portfolios, and the retirement side, ideally for the baby boomers or whatnot that's involved in the equities market that do not trade directly for themselves.
Yeah.
And so there's different strategies. I personally believe that after the great financial crisis, there was a shift in what I would believe should have been a shift in investing strategies in general. So not talk about advice or nothing like that, but just strategies. And so the younger generation, they'll have some time possibly to recover if there is a correction. Mm-hmm. Whereas in the older generation, those that are looking to get out of the workforce now or currently out, they have a much different strategy. So the amount of risk has increased significantly if things do correct or become problematic. As someone who's in the market and looking at things the way you do, what's some differences and probably approaches that you would, kind of throw out there as ideas, suggestions, recommendations for the younger person who has some time perhaps, and then the older person that may not necessarily have time to recoup if there are some major losses?
Yeah, well, this kind of topic actually goes back to when I was with New York Life as a financial advisor, and actually a little bit less than what I'm doing now as a trader. What we try and tell people is that the older that you get and the closer to needing that money, you're going to have to change from a risky portfolio to a more conservative one. You might want to look into annuities. You want to look into, maybe money markets if that's right, mutual funds, and then just generally safer ones. Real estate REITs, I know that we had, 2008 and all that, but generally real estate can be pretty good. You just want to talk to your actual financial advisor and say, look, I'm starting to get older and I need to figure out some ways that I can actually put this money into some safe things. When you're younger, you can be a little bit more aggressive. As you said, you have more time that you can work with. Now, coming from the financial advising industry, I'm a big proponent of life insurance. I'm a big proponent of making sure that you have your insurance in place in the first place, because that's what helps you that when something does go wrong, it doesn't have to come out of your bank account, it comes out of insurance. I know people don't always like the idea of that, and life insurance is kind of a weird thing to think about, but it is something that's very important. And then also you can think of permanent life insurance, which I've got a fair amount of it. I'm a big proponent of it. You got to figure out ways to defer your taxes, and life insurance is one way to do that. And then as you continue to grow, we talk about 401ks and your company match and your IRAs, but not a lot of people talk about a Roth IRA. And a Roth IRA is very important because of the tax deferral situation and the tax-free income you get when you finally do turn around and get it in your later in life. So make sure you look into these other avenues other than just saying, hey, I'm invested in the stock market. But when you're young, you do want to be primarily invested in the stock market. You might want to have some other assets, but make sure you diversify and make sure you understand your tax consequences of what you're going to be getting into when you're later in life, 65, 70, 75.
All right, understandable. So one of the things I would like to definitely highlight and hint on is the fact that the show being labeled Rethinking the Dollar. A lot of my viewpoint happens to be about the long-term consequences of this current emergency measures we're having. And then I like to look at other nations around the world and kind of not necessarily paint a doom and gloom picture, but yet an alternative approach towards the same information we're sharing now. And so when it comes to setting funds aside in markets and in doing type of practical things, the advice that's been given, would you say that it all depends upon what country you're in or what region or what the current governmental policies are? Because a lot of things are problematic around the world. So the same information we're talking about now, perhaps in a country where their currency is an issue, the advice wouldn't necessarily apply because the problem could be the currency. And so in a case where Wild West, can I say, in a Wild West scenario down the line, if there was an issue with the Federal Reserve getting things getting out of hand, and the Federal Reserve note itself became problems. What are your thoughts and strategies for a worst case scenario that we, God forbid, ever happens?
Well, let me first kind of start with the first part of your thing, that if you are in a different country, then yes, you obviously need to know your laws, your rules, your retirement situations over there. We in America aren't going to necessarily know what your IRA or Roth situations are happening in, say, Sweden or China. We're just not going to know that. So you need to know what your country, your laws are, and what your financial institutions are like that. As far as us, that's kind of a big speculative thing. I'm not entirely sure where to go with that, other than saying that, if we have problems, then it's like, okay, how do we then educate ourselves as to where else to go? I know that you can invest in other countries as far as, ETFs. You can go to emerging markets if you wanted to look at that and say, well, I'm not happy with America and what their stock market is doing, but I see over here that maybe Mexico is having a good one. You can maybe invest in commodities, with batteries coming up. You could say, well, maybe lithium is something I want to do to help diversify, because I see that lithium is going to be a big deal for batteries in the next coming decade or 2 decades. There's actually a ticker called SPCE, I believe, and it's for space. You can invest in space projects. You can look at other different things to figure out that don't always have to be with financial securities, don't always have to be directly with 401ks or IRAs. There are other ways to go out there. You can do real estate if you want to do it yourself. You can do hard money loans. You can do, I think, a bunch of other ways to avoid whatever the current economy, as far as the market might be doing.
Interesting. And so as we draw towards the end of our conversation, I'm curious to get your thoughts on just probably two subjects. I got a lot of questions, but I want to respect your time. As far as the current health of our economy here back home on the homeland, with the corporate debt and the issues with the buybacks and, the tax cut that brought money back into our country as a part of the corporations, revitalizing, making America great again. And so it looks like there might be a tax cut 2.0 coming for the middle class sector or whatever. And so the increase in corporations buying back their shares for profit and all the things that go with that, how healthy or unhealthy might that be for, long-term holders of those shares? And I would imagine it's beneficial for the short-term traders and whatnot. And give us some of the impact that, corporate buybacks might have on investing long-term and short-term.
Yeah, as far as the tax break situation, I am generally a fan of a lower tax bracket for corporations. I think we need to be competitive with the rest of the world, which do have lower tax brackets. I also think that if you make higher tax for corporations, they're just going to pass it on to the consumer anyway, because they need to make sure that their margins stay where they are. And so it's really just kind of affect us. I think that also the companies can reinvest in themselves, reinvest in their employees. And I just think that generally lower tax overall is a better situation. Same thing with the middle class. I think lower taxes are great. That way, we have more of our money to decide what we want to do. I think in general, that's how I prefer economies and governments and countries just to run. So I'm kind of a fan of the free market and just lower taxes in general. And as far as, say, corporate debt and buybacks, yeah, you could say it's a little bit of a house of cards when they start to buy this stuff back and it starts to inflate their stock price. I'm sure going back to your PE ratios, it does throw it out of whack. But when we look at stuff, we're technical traders. We look at the chart itself, and as long as it's going up and doing pretty well, we're okay with it. And we have our stops in place that if things change, we get out, and then we wait. The stuff that you're kind of talking about is going to be more for a fundamental perspective with, what is the health of this particular company, and is it really valued at the price that it's valued at for the shares that it has? And that's kind of stuff that, for me, I don't really trade too much with, but it is good to know. And I want to know if we're starting to deal with a giant house of cards with a lot of these stocks.
Right. Well, TG, I appreciate you taking time to join us here on Rethinking a Dollar. It's great to get your insights from someone that's actively trading and whatnot, and you keep an eye on all the measurements and metrics and things I'm excited to learn more about. So hopefully have you back on the show down the line as markets change or whatever, or get better or improve, to get your thoughts. And so can you leave the audience with a way to connect with you, to follow you, to stay in tune with what you have going on, to educate themselves as well?
Yeah. Well, my name is TG Watkins. I'm with Simpler Trading, so simplertrading.com. And my particular channel is Moxie Trader. So if you guys want to look at me there, but you can come out, find us, simplertrading.com, and that's where we are. And I'm sure I'm plastered all over that website. So come take a look, say hi to us, see what we can do. We got some free videos out there. And really what we're trying to do is just help everybody make money and do what they want to do in the future as far as their financial independence. So thank you for your time. I'd love to be on again, and we'll catch up again soon.
Thanks for joining me.